So we're just going to take a look at a company's weighted average cost of capital. So the first thing that we should do is figure out how their total assets are financed. So we can look at that in terms of how much of the total assets are financed with debt, and we also know that as KD. How much of their total assets are financed with preferred stock, and that's known as KP. And then how much is financed through common equity. And that's known as KE. So each company is going to have a different weighting. So I'm just going to create a column for weights. And in this example, we'll just assume that 30% of the total assets are financed with debt. 10% are financed with preferred stock, and 60% is financed with common equity. So each company is going to have a different weight. So when you add these up, 60 plus 10 is 70, plus 30 is 100. It should always equal 100%, because you would actually get that information from the company's balance sheet. Now, each company will also have a different cost associated. So we won't be responsible for doing the formulas in this class, but if we did, we could assume that the cost of capital, so think of this as an interest rate, is 6.55% for debt, which seems pretty low. The cost of capital for preferred stock is 10.94%. So that's getting a little bit higher. And then the cost for common equity is 12%. And what we're trying to do is we're trying to take an average of these costs and apply it to the weight in order to just get one cost of capital. And that's what we call the weighted average cost of capital. So we'll call this the weighted cost. So it's actually quite simple. All you need to do is take the 6.55 and times that by the 30%, and that'll give you 0.01965. Then take the 10.94 and times that by 10%, and that will give you 0.01094. And then take the 12% times the 60%, and that'll give you 0.072. And now what we do is we just add these three together, and that'll give me 0.10259. And I want to express that as a percentage, so I'll just change that to 2 decimal places, 10.26%. So that means that the cost of the total assets to finance them is about 10.26% interest. And this is really important because when we're trying to figure out whether or not we should accept capital projects, we're going to look at the weighted average cost of capital, and anything that is above that, we would recommend doing the project. And anything below that we would reject because the new projects wouldn't even cover the current cost of capital for the total assets. So just to recap, the required rate of return should always be greater than or equal to the weighted average cost of capital in order to accept.